Welcome to my YouTube channel where I will be discussing inflation and interest rates in 2024. As we step into 2024, the economic landscape presents a complex tapestry of challenges and opportunities, with inflation and interest rates at the forefront of financial discussions. Over the past few years, rising prices have significantly impacted consumers and businesses alike, leading to a heightened awareness of how these economic indicators shape our daily lives. Understanding the intricacies of inflation, what drives it, how it affects purchasing power, and its correlation with interest rates, is crucial for making informed financial decisions in this evolving environment. In this blog post, we will delve deep into the mechanisms of inflation and interest rates, exploring their historical context, current trends, and potential forecasts for the year ahead. Whether you're a savvy investor, a small business owner, or simply someone looking to manage your personal finances more effectively, this guide will equip you with the knowledge you need to navigate the economic landscape of 2024 with confidence. 1. The basics of inflation, what you need to know. There are several key factors that contribute to inflation. Demand pull inflation occurs when the demand for goods and services exceeds their supply, pushing prices higher. On the other hand, cost push inflation arises when the costs of production increase, such as wages and raw materials, leading businesses to pass those costs on to consumers. Additionally, built-in inflation is linked to the adaptive expectations of wages and prices. As people expect prices to rise, they demand higher wages, which can create a self-fulfilling cycle of inflation. Inflation is measured using various indices, with the Consumer Price Index, CPI, being one of the most widely recognized. The CPI tracks the average change over time in the prices paid by urban consumers for a basket of goods and services, providing a clear snapshot of how inflation impacts everyday spending. As we approach 2024, being informed about inflation is crucial. Understanding its drivers, implications, and how it interacts with other economic indicators, such as interest rates, can help you make more informed financial decisions. Whether you're looking to invest, purchase a home, or simply manage your household budget, grasping the basics of inflation will empower you to navigate the evolving economic landscape with confidence. 2. Historical trends. How inflation and interest rates have evolved. In the late 20th century, particularly during the 1970s, the world faced a notorious period of stagflation, characterized by high inflation rates that often surpassed 10%, coupled with stagnant economic growth. This prompted central banks, particularly the US Federal Reserve, to implement aggressive monetary policies that significantly raised interest rates to combat inflation. The late 1980s and 1990s saw a stabilization of these rates as economies adjusted and inflation gradually decreased, leading to a prolonged period of economic growth and relative stability. The early 2000s brought about a shift, with a notable decline in interest rates as central banks aimed to stimulate economic recovery following events like the dot-com bubble burst and the 2008 financial crisis. This era of low interest rates encouraged borrowing and spending, but also set the stage for the inflationary pressures that would emerge in the late 2010s. The COVID-19 pandemic in 2020 led to unprecedented government spending and supply chain disruptions, which combined with pent-up consumer demand to create a surge in inflation that caught many economists off guard. As we moved into 2022 and 2023, inflation rates soared to levels not seen in decades, prompting central banks worldwide to respond with aggressive interest rate hikes. These decisions aimed to rein in inflation, yet they also sparked concerns over potential slowdowns in economic growth. Understanding these historical trends is crucial for navigating the complexities of today's economic environment. As we look toward 2024, the interplay between inflation and interest rates will remain a key focus for policymakers and consumers alike, shaping the decisions that will impact financial markets, borrowing costs, and overall economic health. By recognizing the cyclical nature of these indicators, we can better prepare for the challenges and opportunities that lie ahead. 3. Current economic indicators. Analyzing the 2024 landscape. In parallel, interest rates have been adjusted in response to inflationary pressures and the overall economic climate. The Federal Reserve has taken a cautious approach, implementing a series of rate hikes aimed at curbing inflation while remaining sensitive to the potential impact on economic growth. As a result, borrowing costs for individuals and businesses have increased, influencing decisions on everything from mortgages to expansion plans. Moreover, employment figures remain robust, with unemployment rates holding steady at historically low levels. This balance between a healthy job market and rising costs presents a unique dynamic. While wages may be on the rise, many workers are still grappling with the reality of inflation outpacing income growth. In summary, navigating the economic landscape of 2024 requires a nuanced understanding of these interrelated indicators. By keeping an eye on inflation trends, interest rate adjustments, employment data, and consumer confidence, stakeholders can better prepare for the road ahead and make informed decisions in an ever-evolving economic environment. 4. The impact of inflation on consumers and businesses. Inflation is a critical factor that shapes the economic landscape, influencing everything from the purchasing power of consumers to the operational costs of businesses. In 2024, as inflation rates fluctuate, both consumers and businesses are feeling the effects in profound ways. For consumers, rising prices mean that everyday essentials, such as groceries, gas, and housing, cost more than they did in previous years. This decrease in purchasing power often forces families to adjust their budgets, prioritizing needs over wants, and seeking more cost-effective alternatives. Many are turning to discount retailers, buying in bulk, or exploring second-hand options to stretch their dollars further. On the business side, inflation presents its own set of challenges. Companies face increased costs for raw materials, transportation, and labor, which can severely impact profit margins. In response, businesses may raise their prices to maintain profitability, but this can lead to decreased consumer demand if customers feel the pinch of higher prices. Moreover, companies that rely heavily on borrowed funds may find themselves struggling with higher interest rates, making it more expensive to finance operations or expansion plans. In summary, while inflation presents significant challenges for both consumers and businesses in 2024, understanding these dynamics is crucial for navigating the economic landscape effectively. By being aware of how inflation impacts spending habits and operational costs, both groups can make informed decisions that help them weather the storm and potentially thrive in a shifting economic environment. Thanks for watching. Kindly like, share and subscribe for more educative